So let's go ahead and dive in and get started. Here we go. Hey, we're at 23 people. We're getting there. All right. So a lot we're going to cover today. The first thing is we're going to talk about what is the California Dream for All program. We're going to talk about how does shared appreciation work. We're going to discuss, is this even a good idea? What are the pros and cons to this program? And then we're going to go through some details. So we'll cover really what are the qualification rules, and then we'll talk about how to make your dream a reality. What are the next steps for you? And then finally, we'll wrap up with some Q&A. One of the things that I do want to mention, a lot of people, pretty much everybody who's here is a first-time home buyer because this program is designed for first-time home buyers. And I do a monthly webinar that is my How to Buy a Home Masterclass. And so if you would like to join that, it's this Thursday at 7 p.m. It's from 7 to 8:30 on the third Thursday of every month. But this month, my son's birthday was last week, so I'm doing it on the fourth Thursday. So I'm going to put into chat real quick, howtobuymasterclass.com. And you can go to that website and you can register. It's really, really informative for first-time home buyers just to understand the process from start to finish, because we're not going to talk about the loan process at all tonight. But it explains just what lenders look for and why, how the home buying process works, what you need to do regarding picking a realtor, and just really a good understanding of the market. Is now a good time to buy? All of those things I address in my How to Buy Masterclass. And so join me this Thursday from 7 to 8:30 p.m. For that class. I think you'll get a lot out of it. All right, so enough promotional material for my next class. Let's talk about this one. What is the California Dream for All program? So it is a shared appreciation program where you're getting 20% of your down payments provided to you by the state of California. Now, what they're doing is they're giving you 20% of the purchase price, and in exchange, they want 20% of the appreciation or 20% of the growth in the value of the home that you're buying. Now, I like to use a simple example here to help people understand it, because one of the first things people say when I explain this to them is, gosh, John, I think I'm giving up a lot of money here. Like I'm paying, if my house goes up by $200,000, I'm paying the state $40,000 to basically give me a loan on the house. That is a true statement. But here's the other way to look at it. The state's taking a huge investment into your home. Kind of like if you said, hey, you had a family member who wants to give you a leg up in becoming a homeowner, and they say, you know what, I'll pay for half of your home price. No, the state's not paying for half the price. But if somebody says, I'll pay for half of the home price for you, all you have to do is pay the payment on the other half, and you get to live in the home. And when you sell the house, I want to get my half of what the house goes up, and you get your half of what the house goes up. No different than if you bought with your sister and the two of you purchased a home. And your sister says, look, I'm going to buy with you and we're both going to live there. And when we sell the house, whatever it goes up, we're going to split it 50-50. That's only fair. Well, in this case, the state of California is buying 20% of the home price for you. And all they want in return is their portion of the appreciation. You're only making payments on 80% of the home price. Now, the example I'm going to use tonight is I'm going to talk about a $500,000 purchase price. And on a $500,000 purchase price, you're getting 20% or $100,000 from the state. So you're only making payments on $400,000. And you get the appreciation on your $400,000. What you don't get is the appreciation on the $100,000 that the state provided to you in assistance. So I think it's a pretty fair breakdown of who gets what and why. Now, there's some negatives to this, and I'm going to cover all of the pros and cons and everything in between while we're talking tonight. But to be clear, you're getting 20% of the purchase price from the state when you sell the home, when you refinance the home, or in the 30 years when you finish paying off this mortgage, the state's going to say, okay, what's the house worth today? At that moment, they're going to calculate how much has the home gone up compared to when you bought it, and then they're going to want 20% of that appreciation. Now, that's a 1-to-1 ratio, meaning if you only want 10% of the purchase price from the state, then you only pay back 10% of your appreciation. So you really get to choose how much that you're taking. All right, so how does shared appreciation work? Let's go through a simple explanation. So if you have a $500,000 home that you are purchasing, Your first mortgage, which you will make the payment on, is for $100,000. Let me get a little handy dandy pointer here. All right, perfect. So your first home's $500,000. Your first mortgage is $400,000, and that's what you're making payments on. The second loan is the Dream for All loan, and it's providing you with $100,000. So you pay on $400,000. The state gives you the $100,000 as a loan that you'll pay back later. Well, what happens later? In 5 years in this example, let's pretend the home value has gone up from $500,000 to $640,000. That means that there's a $140,000 difference between what you bought it for and what it's worth at that moment. Well, your 80% is $112,000. The state's 20% is $28,000. Now, if you decide at that moment, I want to sell the home. Well, your first mortgage started at $400,000, but for 5 years, you made payments paying down your principal. It's actually one of the things that I talk about in my How to Buy Masterclass is that there's 3 ways in which you build wealth through home ownership. One of those 3 ways is paying down your balance. It's called my forced savings account. It forces you to pay yourself some money every single month because you're paying down your principal. And in 5 years, that $400,000 loan, you only owe $370,000. So you sell the home for $640,000. You pay back the $100,000 that you owed, plus 20% of the appreciation, or $28,000. The state gets $128,000. But you walk away with $142,000. Now you guys are going to think, wait, John, you're not very good at math. The house was appreciating by 140 and I paid them 28. So don't I only walk away with 112,000? No, because you have the extra 30,000 you paid down the balance. So you walk away with $142,000. Now, one of the things that people say a lot to me is, John, I just want to get 100% of my equity. I deserve all $140,000 of that appreciation, plus my 30,000 I paid down the balance. Okay, then come up with your own down payment. And if you can, you should. But if you can't, then you should not freak out about, oh my gosh, I'm paying the state this money, because you wouldn't be a homeowner. And if you're not a homeowner, you're a renter. And guess how much money landlords share with you of the appreciation? 0. So it's really about, can I get into a home with a payment I can afford, with money out of my own pocket for a down payment? If you can, do it. But if you can't, stop using that as a challenge, an obstacle that stops you from becoming a homeowner, because in this case, you're still building equity, a significant amount of equity. So here's where the money comes from. You get $142,000, $112,000 was your appreciation, $30,000 was how much money you paid down the equity. Okay. So essentially what the down payment assistance program is then going to do is recycle those funds. So this is where people misunderstand how this program is designed. The program is designed to essentially be a long-term project for the state. And that means that the state is funding this with $500 million right now. Problem is that money's going to run out pretty quickly. I think the math, if the average home price in California is $600,000 and everybody takes 20% of the purchase price in assistance, then it's going to help about 4,100 families. So the question is, how long is this money going to last? I think we're looking at 6 to 9 months at the longest. Now, the good news is there's a plan to replenish the money. And the plan is to replenish the money with twice as much money, with $1 billion every year going forward. But there's going to be a gap. There's going to be time, in my opinion, that it's going to run out of money, and anybody that wants to buy during that time cannot use this program. And it requires you to be a first-time home buyer. I'll get into that in a couple of minutes. So once you buy a home, if you don't use this program, you won't be able to use it again in the future unless you have not owned a home in 3 years. I'll explain more of that in a couple of minutes. But here's where the state is thinking ahead. When they're saying at a certain point, this becomes a revolving program where the money is recycled. When you pay off your loan, it goes back into the program to help somebody else buy their home. So the money is going to last into perpetuity because the money that you're paying back in equity helps the next person buy their home. All right, so let's talk about the pros and the cons. In all kinds of sales and all types of deals, there's always a negative. And most people only focus on the positives. I'm going to give you the truth about both sides of this. So first of all, one of the pros is that you only make payments on 80% of the price. So if you're in a position where, hey, John, I just can't afford a house over $400,000 and the houses that I need are at $475,000. This program allows you to purchase a $500,000 home with the same payment you would have had on a $400,000 home when you didn't have this big of a down payment. So you're making a smaller monthly payment on a better home. It offsets the affordability problem that comes with inflation. We've all seen it. You're all thinking about buying a home. So you've watched over the last year and a half as we've seen interest rates go up and up and up and up and up. And it's created a major affordability issue. And here you're basically getting a 20% reduction in what your monthly payment would be at any purchase price. So it really helps offset that affordability problem. The next really cool thing, there's no mortgage insurance. So if you're right now qualified for an FHA loan or a small down payment loan, you're paying a pretty sizable amount of money in mortgage insurance. This program, because you're putting 20% down, does not require mortgage insurance. So it's a really, really good opportunity to get into a home with little to no money out of pocket without having to pay a monthly mortgage insurance fee. You can buy a better home because you might be in a position where you say, John, I qualify for $400,000 and I can afford a $400,000 home, but there's just nothing I like, nothing that's in a neighborhood that I want, nothing that's in the school district that I want. And so this program lets you buy a better home for the same monthly payment. Or it can let you have a lower payment or both, meaning that you might be in a position where, hey, I qualify for $500,000, but I really don't feel comfortable making that monthly payment. So even though I can find homes at $500,000 and I qualify for that, this will help you get a lower monthly payment. And it really provides a lot of flexibility for you to come up with, and me to help you come up with creative options. The final thing is stop renting. Look, your landlord doesn't share any of the appreciation. You get none of the three benefits of wealth building through home ownership: tax deductibility, forced appreciation, and equity, or how much the value goes up. You get none of those being a renter. And with this program, it gets you to stop being a renter and start becoming a homeowner. Now, what are the cons? What are the negatives? The first thing is you're not getting as much money from the sale of the home. So when you sell your home, if you didn't use this program, you get all of the money that the home price goes up. But using this program, you're only getting 80% of the increase. For some people, that just isn't something they're willing to do, and they don't want to give up any of that money. I completely understand. Here's another pretty big negative. You pay all of the fees for selling the home. Now, as a home buyer, you don't pay for your real estate agent. Your seller, the seller of the home you're buying, customarily pays for the agent representing them, and it pays for the agent representing you. I'll go into more detail on all of that stuff in my How to Buy Masterclass on Thursday. But as a seller, you're paying for both realtors. That can sometimes be 5 to 6% of the purchase price that you have, or the sales price that you're paying in fees. Well, if you were buying with your sister and then you sold the house with your sister and you're splitting it 50-50, your sister would pay 50% of the fees for selling the home. The state of California doesn't do that. The state says, look, the price of the home went up $100,000. You're paying me 20% of the $100,000 plus the money you originally borrowed. Okay. So what about those fees? What about the fact that I have to pay the cost of selling the home? The state says, look, it's too hard to be fair in that regard, because there's times when maybe your property's in bad condition and you've got to pay for a lot of repairs, or you have to get credits for closing costs in order to offset the condition of the property. There's no way the state can manage that and not be taken advantage of. So the only way that they can do it in a fair way is to say, look, we just have to take what you bought the home for compared to what you're selling it for, and we get 20% of that increase. So I call that fair. It's not fair. You are paying 100% of the cost of selling the home. The truth is you should only pay 80% of the cost of selling the home, but the state's not going to do it that way. And they're the ones providing you the money. So this is one of those cons. You don't have an option, but it is one of the biggest negatives about this program. All right. Another con, you can only refinance once without triggering repayment. Now, I'm talking a little bit about this, and it's actually a really, really good thing. It's actually a thing that makes this an amazing program, is that we expect it to allow you to refinance one time. And I should time out for a quick second and be really clear. If you look in the bottom left corner of my PowerPoint, it says preliminary rules, and they're subject to change when the official rules are published March 27th. This program is launching next Monday. I did a webinar like this last week on the 13th. I'm doing one tonight, and I'm doing another one next Monday on the 27th. I have a full copy of what the rules are, but even the rules that I have say preliminary rules, but they may change when the actual guidelines come out on March 27th. So everything I am saying today is subject to change. I don't expect it to. Here's why. Because they gave those rules to direct lenders such as my company so that we can prepare to launch this program next Monday when it is going live. And if they completely throw out the rule book they gave us to prepare and start over with brand new rules, no lender is going to be able to actually launch on launch day. So yeah, technically something could change. And that's why I'm giving you the same disclosure that something could change, but I don't expect it to. And the reality is loan programs change guidelines often. So when your lender, hopefully that's me, I'm interviewing for that job right now, by the way. When your lender gives you an approval letter, if the guidelines change between the time that you get your pre-approval and the time that you find a home, your approval isn't good anymore. There's no grandfathering in just because you got pre-approved by a certain date. So just because this program has expected rules that may change next Monday, the truth is even when they're released, those rules can change over time. So the fact is, if you don't use this program, you can refinance as often as you want as interest rates come down. And we see interest rates really high. You see them right now. Again, on my masterclass, I'm going to talk about where I see the interest rate market going and why. So join me on Thursday. But as I explain why interest rates are going to go down on Thursday, just trust me that I expect over the next few years, we're going to see interest rates drop. And with this program, you can only refinance once to get a lower interest rate without paying back the state. After that, you have to pay back their portion. So the biggest question is going to be, when do I refinance? Well, that's where I'm going to help be your guide. But the truth is I'm throwing a dart against the wall just like you are. We're going to see interest rates fall. Maybe they're at 6.5 now and they're going to fall to 5. Do you pull the trigger and refinance then? Or do you wait hoping they'll fall to 4? And if you wait and they never fall to 4, then you've been paying 6.5 longer than you needed to. So there's no right answer. Murphy's Law says the minute you pull the trigger to refinance, rates are going to drop a month later. But I'm going to help guide you through that process and give you my experience on where I think rates are at and where I think they're going to be going forward to help give you some guidance on should you refinance now or should you not, because we only have one opportunity to refinance. If you actually, how do I want to say this? If you didn't use this program, then you would be able to refinance as many times as you want, and you don't have to worry about paying back a second mortgage. So that is definitely a negative to this program. All right, so let's talk about how the money can be used. You can use up to 20% of the purchase price for down payment and closing costs. Now, how do we do that? Because we can shift how much goes towards down payment versus how much goes towards closing costs. Now, closing costs with down payment assistance loans are higher than closing costs for normal loans. That's another negative I probably should have put on the prior screen. You're paying more in closing costs. Now you can pay that out of your pocket, or you can use up to 5% of the purchase price to cover the closing costs and use the other 15% of the assistance loan to pay 15% down. You can also combine some of your own money. Now, I got a question, I think, on Facebook. Somebody's asking if this was for single-family residences or condos and PUDs qualify. I'm going to talk in a couple minutes about that, and I'll cover that question. So if you guys have questions that are watching on Zoom, feel free to post them into chat. My wife is watching the Facebook feed, and she'll be feeding me any questions that come through Facebook. All right, so you can put as little as no money out of your pocket. Now, let me be really, really clear. You need some of your own money. And when I say some of your own money, you have to pay for the appraisal. That's between $500 and $700. You have to pay the earnest money deposit. That's the upfront money that you're paying to the title company to basically say, hey, I'm not going to back out of this transaction without a good reason. And if I do, if I just change my mind for the heck of it, you can keep that money. So that earnest money deposit tells the seller you're serious. Now, there's no minimum requirement. You could say, I'm not putting any earnest money deposit. But the seller, if he has anybody else willing to write an offer that is willing to put up some money, is likely going to win that offer compared to you. And I go into the strategy of a lot of this stuff in my How to Buy Masterclass on Thursday. But you can you can buy with as little as $2,000 out of pocket by using 5% of the purchase price from the assistance money towards closing costs and the other 15% towards down payment. And the cool thing is that, yes, you have mortgage insurance because you're not putting 20% down, but I can actually prepay that mortgage insurance so that it's just a one-time fee that's included in the closing costs as long as you have good credit. And we'll talk about what the credit rules are in a couple of minutes. Here's the other side of the coin. You can add some of your own money. You might say, hey, John, this has been a great presentation, but I don't want to share the equity because I already have 20% of my own money. Well, guess what? If you're buying a $500,000 home and you have your own $100,000 to put as a down payment, you can make a payment on $400,000. Or you can combine the state's $100,000 plus your $100,000. Now you're only making a payment on $300,000. You're putting 40% down, but you're still only sharing 20% of the equity because that's the portion the state bought in. And you don't have to share, you don't have to get the full 20%. So you might say, hey, I want 20% of my own money and 10% from the state just to make the payment a little bit more affordable. And now you only have to share the portion of what you take from the state. I'll cover more of that in a minute. But here's the limit. The limit is 30% of the purchase price from your own money plus closing costs, and then another 20% from the state. That means that you can actually put 50% down payment between your 30% and the state's 20%, and you're only making payments on half of the price. All right, so somebody just asked me a question, but they put it in a direct message. What would be the next steps after pre-approval to get the funds reserved? If we put earnest money deposit and confirm the house, what if we don't get the 20%? Okay, so I'm going to answer this right now. So the question was, by the way, if you do post a question, try and post them into chat to everybody so that everybody can see the question as well. But what the question is after pre-approval, if we identify a house, what would be the next steps? So you're going to write an offer on the home using a realtor. I'm going to go through all of this stuff on Thursday night as well. And the funds are reserved once you get in contract. So once your offer is accepted from the seller, that's when I lock in the interest rate, and that's when I reserve the funds. Now, if you happen to get a pre-approval this week, I've got some people on this call right now that are already pre-approved and they're out shopping. I have one contract. I just got my first contract in for somebody using this program literally about 20 minutes before the meeting started. So congratulations to that buyer. They are my first buyer using this program. Now, here's the deal. I can't lock their interest rate until Monday. And I'll explain more about that as we move forward. But to answer your question, we lock the interest rate and reserve the money as soon as you're in contract, unless you go in contract before the program launches next week, in which case I have to wait until next Monday. And then contingencies in your contract protect you so that if you write the offer, you get the offer accepted, and then the state has run out of money, then you have the ability to back out and not lose your earnest money. It's called your financing contingency. And in some really competitive markets, you need to not have a financing contingency. You need to waive your financing contingency, but I don't recommend it with this program, especially A, in the beginning when we're still not sure where the rates are at, and B, as we get further along in the next 3 to 6 months, the program might run out of money, and you need to have the financing contingency in place so that you get your money back. All right, Raj has a question. He says, how about for real estate, which is a buildable plan where the house is given 6 to 8 months after to be built? You cannot freeze the money until 30 days before the home is finished. So this works fine for new construction where it's called a spec home, where the home is almost finished being built. But if it's new construction where the home is not going to be built for a while, you have to have a backup plan of, do I qualify without this program? And then if there's still money with the program, you absolutely can use it and reserve it at that time. But the lock on this program is a 30-day lock. And so you cannot use it to purchase a new construction home that isn't close to being completed. All right. So again, guys, if you have questions, feel free to ask them in chat. I'm going to keep going here. So take only what you need. Now, most of the people I'm talking to are taking the full 20%. But if you have some of your own down payment, you can layer it with the down payment assistance. And maybe you say, John, I have 20% or 10% for my own down payment, and I only want to take 10% from the assistance program. Then you only pay back 10% of your home's appreciation. So you pay less money back to the state if you take less money from the state. Now, there's a rule here that's a little bit confusing. I'm only going to gloss over it. There's a threshold called low income, where you make less than 80% of what the area median income is. If you are at low income, then you only pay back 3/4, 75 cents on every dollar of what everybody else pays back. So if you take 20% and the house goes up by 100,000, most people would pay back 20,000. If you're low income, you only pay back 15,000. You pay back 75 cents on the dollar. All right. Alfonso asks, is it possible to be pre-approved right now before the money is available from the state? The answer is 100% yes. I know enough of the rules and how they work that for my clients who are well qualified, I'm giving them pre-approvals now. For people who are on the borderline, we're holding off until we get the final rules to make sure. And I'll explain to you what some of those borderline things are. But again, I've got people out shopping right now, and I actually got my first buyer into contract about a half hour ago. All right. So how can you use the money? You can use it to increase your buying power or to lower your monthly payment to be within a certain budget. So the other thing, and I already talked about this, but it's limited funds. I expect them to be replenished, but just be aware that this money is a set amount of money. $500 million right now sounds like a lot of money, but if everybody's taken, $120,000, that disappears after about 4,100 people. So it is going to replenish, but I don't know what the gap is between when we run out of money and when it's going to be replenished. All right, so let me show you the numbers. Let me show you kind of how this breaks down. The first thing I want to remind you is interest rates will not come out until next Monday. So I don't know if this program is going to be at market rates, below market rates, or above market rates. And that's a major unknown. Market rates are in the mid-6s right now on average. So CalHFA, who administers this program, has some similar programs, and they're all at or maybe a little bit below market rates. But I don't know about this program and whether it's going to be at, above, or below. So the numbers I'm showing you are above market rate at about a 6.99% interest rate. I expect and hope that the numbers are going to be closer to 6.5 or below. So let's walk through how this works to increase your buying power. So if you are approved for a $400,000 home and your payment on that $400,000 home is $3,300 a month based on a 6.99% interest rate, and you need about $26,500 to close. So that's a normal conventional loan with 3% down. This is what your lender would have told you as your options, and maybe you can use down payment assistance to cover some of that $26,000, but this is really what your monthly payment's going to be. Now we say, well, how can we stretch this buying power? Well, we could go to FHA. FHA, I probably could go up another $10,000 because rates on FHA are lower. And for the same monthly payment, a little bit more out of pocket, you're able to bump your purchase price by $10,000. But how do we get a higher price? This is where we use the California Dream for All program. We can take that $400,000 approval with a 3% down payment, and we can change it to a $500,000 approval at 6.99 estimated interest rate. Your payment is still around $3,350 a month, but you're coming up with even less money out of pocket for closing costs. Now, on this traditional loan, that $27,000 was your down payment of 3% plus your closing costs. With the assistance loan, this is all closing costs. So it's a pretty expensive loan, but again, it gives you flexibility to buy a $100,000 higher priced home with having a monthly payment similar right here. Okay, Roshana asked a question. I will cover credit scores in a couple of minutes. So we'll cover that in just a couple of minutes. All right. Now, here's the other way to look at this, and that is how about if we come up with no money out of pocket or next to no money out of pocket? And this is the scenario where we do that. And that is that we lower the purchase price a little bit. So we maybe pull back to $480, because remember that $3,350 is our target payment that we're trying to keep you at. But in lowering the price to $480, I'm only putting 15% towards the down payment. So I'm loaning you 85% of that purchase price. The rest of the 5% I'm using for closing costs, and you're coming up with about $1,400 out of pocket. So the same payment you were going to have over here on a $400,000 home with $27,000 out of pocket, you can buy a $480,000 home and you only have $1,400, $1,500, $2,000 ballpark numbers. That's all you have out of pocket. It's an amazing opportunity to help you increase your buying power. Now, let's talk about how this helps to lower your monthly payment. Julie asked a question. Julie, I'll cover your question in a couple of minutes. So the answer, by the way, Julie asked, can the purchase be multifamily property or duplex? That is one of the things that I do not know and won't find out until next week on Monday, but I don't expect it to allow multifamily. I do have a different down payment assistance program where you can put 5% down up to a 4-unit property and get assistance for that 5% down payment. It is not this program. Okay, but I do have another way to help a first-time home buyer purchase an owner-occupied multifamily residence if this program doesn't allow it. All right, Harpal asks, someone paid the amount before the 30-year term. So I will cover that in a couple of minutes, Harpal. I have a slide that goes into that. Okay, so let's dive in and talk about how this would help lower your monthly payment. So let's pretend that you met with me a month or 2 or 6 ago, and you said, John, I want to buy a house at $500,000. And I said, okay, fine. So we're going to do a 3% down conventional loan. And at 6.99, that's going to have your payment at $4,200 a month. And you're going to need about $32,000 out of pocket. Raj, I'll get to your question in a minute. So you're having about $32,000 out of pocket. And you're like, well, John, that's good. I can find homes at $500,000 I'm looking for, but I can't afford $4,200 a month. That's crazy. I'd rather rent. Remember, the equity you get on renting is how much? It's zero. You get nothing from your landlord for the money that you're paying them every single month in rent. And every year they raise your rent. Home ownership, your payment typically goes down over time. You might pop up right now, but over time it's going to go down. So you say, John, I can't afford $4,200. I'm out. I'm not going to do it. And I say, okay, hey, wait a second. I got another option. I can do an FHA loan. And because the interest rate's lower, I can save you about $130 a month. Yeah, I need a few $1,000s extra out of pocket, but I'm going to save you $130 a month. Do you want to do it? We're like, I'm sorry, John, but $4,000 a month is just not going to work for me. I don't have that option. So now with the California Dream for All program, you're buying this $500,000 home. Raj, I think this answers your question, and I'm going to reread your question as soon as I finish, because I think I'm about to answer it. So the $500,000 loan you get or $500,000 home, you're now only going to borrow $400,000 because the state is giving you a loan for the 20% or the $100,000. So your payment is going to be $3,300 a month for a $500,000 home instead of $4,200 a month for a $500,000 home. And you need less cash out of pocket. Now, to Raj's point, he says, if I intend to purchase a house worth $500,000, would my qualification be based on the full $500,000 or would it be based on the lower loan amount of $400,000? It's based on this number right here. I would qualify you for a $3,300 a month payment. And so you would, if you only qualified for $3,500 a month, you could not do this loan because it's $700 more than I would let you spend. But with this new program, you do qualify. So if a lender said, no, Raj, you don't qualify for $500,000 because your income's not enough to pay it. Well, guess what? Now you might qualify because you're saving $876 a month, and therefore it's making you easier to qualify for that monthly payment at $500,000, and you're coming up with less cash out of pocket. Or you can switch it up and say, you know what, John, I like the $500,000 home, and I like having a lower monthly payment, but I'd love to drop how much money I'm paying out of pocket. Okay, no problem. Then let's do the loan with 15% down and use the other 5% to pay for the closing costs. That means that your payment is going to be $3,500 instead of being $4,200, saving you $710 a month, and you're only coming up with $1,000 to $2,000 out of pocket. So this is how you can use this program to your advantage so that you can say, hey, I don't want to buy at a $500,000 price and make a payment on $500,000. I want to buy at 500,000 and make a payment on 400,000. And that is exactly what we are doing here. So Raj, I think that answered your question. Harpal, I still will be getting to your question in a couple minutes. All right, so let me move my windows out of the way here that I've got my chat screen up, and let's talk about who qualifies. First of all, you have to be a first-time home buyer. Now, the definition of a first-time home buyer is unique. Most people think that means you've never purchased a home. Well, that isn't the case. What they mean by first-time home buyer is that you cannot have had ownership interest in a principal residence during the past 3 years. Now, that doesn't mean, people misunderstand this so many ways. What it does not say is it's been more than 3 years since you bought your home. Some people misunderstand and think, well, I bought my home 10 years ago. I still own it and I still live there, but it's been more than 3 years since I bought it. And the fact is that does not work. You do not count as a first-time home buyer if you owned the home that you live in, no matter when you bought it. Okay, so you cannot have ownership interest in any principal residence in the last 3 years. Now there's a loophole. There's a loophole that just slammed shut, and that was that lenders and realtors used to advise their clients that, hey, if you're married and your spouse and you both have really good income, how about trying to qualify to buy the home under one person's name? Because then a year or two later, you can move out of that one and the other spouse can buy something and they can call it their first time home as well. Well, that loophole closed. And basically what they said is, look, you cannot have had ownership interest or resided in a home owned by a spouse anytime in the last 3 years. So if you're in that position where you live in a home that is owned by your spouse, you do not qualify as a first-time home buyer. But here's the cool thing. If you sold your home more than 3 years ago, or if you moved because maybe you had to relocate and you converted that home to a rental property, you still qualify as a first-time home buyer. So it is not about having not owned a home. It's about not having owned the home that you live in as your primary residence. All right. Income limits do apply. Now, the income limits vary by county, but they're pretty generous income limits. And as a matter of fact, I'm going to try and pull them up here over on my iPad because I know everybody asks, but the income limits, I will be publishing the income limits on my website, which is californiadreamforall.info, and they should be out later on well, actually, I'll publish them on Monday when they come out. I am pretty sure the income limits are going to match what CalHFA currently uses for their income limits. But that is one piece that I'm still not 100% sure of, but I'm about 90% sure that that's what they're going to base their income limits on. And the CalHFA income limits statewide vary from county to county, but you're looking at a minimum of $159,000 in income, no matter what county you're in. And it's qualifying income. So if one person makes $150,000 in salary and $30,000 in bonus, and their spouse makes $100,000, that means that the borrower is at 150 plus 30 in bonus, and then the spouse makes 100, they're at $280,000. But the income limit's 159 in your county. As long as you qualify on your base income, I can ignore bonus income. We just don't show it as recurring or repeating, and we can ignore bonus income, and I don't have to claim the income from your spouse. They can be on the loan. We just leave the income section blank. So there's ways, just if you make more than the income limits, don't automatically disqualify yourself. Talk to me first, because there's ways we might be able to change how we look at the numbers. But as an example, in the Bay Area counties, you can make up to $300,000 as the expected income limit to be able to qualify for this program. So the income limits are very, very generous. Nancy said, wouldn't I anticipate the money to run out sooner than 6 to 9 months? 3,000 people's not a lot. I'm worried the money would run out sooner before I can find a home. You're right. And I am concerned. So I'm saying that, I think that I think the money will last. Somebody said, hey, John, I think it'll go out in 3 months. I don't think it's going to go out in 3 months. First of all, it's closer to about 4,000, 4,500 families. And there's a bottleneck right now of homes available for sale, which is why I'm saying I think it'll last 6 to 9 months, because there just aren't enough homes listed for sale. And therefore, it's going to create kind of a demand problem. That's what I'm most concerned about, is it's going to be hard to find a home because there aren't going to be enough homes listed for sale. So yeah, I definitely am guessing when I'm saying 6 to 9 months, Nancy, and I could be very, very wrong. But it is absolutely why I'm telling people to get qualified immediately and start looking right away. Sabat asks, citizen status along with U.S. citizens, green card holders. So that is something that's going to come out next week. So I do not know what the citizenship requirements are going to be until they release the program guidelines on Monday. So that is one that you'll need to reach out to me again next week to confirm. I do think they'll be fairly flexible with visas as long as it meets Fannie Mae's guidelines, and this program is backed by Fannie Mae. All right. So speaking of Fannie Mae, these are conventional loans only. So if you've been pre-approved by me or by another lender and they said, hey, based on the recency of your bankruptcy, based on your credit score, you're an FHA borrower. You cannot use FHA for this program. You cannot use VA, you cannot use USDA, you cannot use Freddie Mac either. So Fannie Mae and Freddie Mac are the two government entities that are the conventional loans, okay? So what you're looking at, Alfonso, I'll cover your question in a second. So what you're looking at is you're looking at the guidelines from Fannie Mae specifically. There's very few differences between Fannie Mae and Freddie Mac, but some have to do with how we look at self-employment income. Sometimes it has to do with how we look at student loans. But to be clear, this only applies to people who are using Fannie Mae for their financing. That's the only way we can qualify for the California Dream for All program. You must occupy the property in 60 days. And you've got to stay there for a year. Some people have said, hey, John, I want to buy the house and I want to rent it out a year from now. Based on the rules that I know of right now, subject to change next Monday, I see no requirement that you stay in the house long-term. Moving out is not a trigger to pay back the states, okay? All right, so keeping going through here, non-occupant cosigners are not allowed. So a non-occupant cosigner is saying, hey, John, I'm living in this house by myself, but my mom is willing to put her name on it to help me qualify because my income's not enough. I just opened a new business and I'm self-employed and my taxes don't show very much profit and I don't qualify by myself, so I need my mom to co-sign with me. As far as the rules are that I know of right now, co-signers are not going to be allowed. So you have to, everybody who's on the loan must occupy the property and they must be first-time home buyers. All right, Alonzo is asking how many can qualify on Monday. So Alonzo, I'm working through a list. You are on that list of people that I'm working to get qualified ahead of time. So we're not waiting until Monday to get qualified. I'm also not going to be able to qualify everybody on Monday that is going to want to be. And so at the end of this presentation, if you've not ever put in an application with me, I'm going to encourage you to do that. I'll have a QR code and a link on the screen that you'll be able to take a picture and submit your application. After last week's presentation, I had a dozen people that submitted applications so that we can get in line, and about 6 of them have already been pre-approved. Tristan says, do you have to find a home first to approve this loan, or can you get approved for the loan in advance and then search? You are approved in advance, but the money is not reserved in advance. So I'm going to approve you, and then you're going to shop, and then once you find a home, then we're going to freeze your interest rate and set aside your chunk of money. If by the time you find a home, there's no money left, then just because you got pre-approved doesn't guarantee there's money there for you. So I think that's where your question comes from. And yeah, so perfect. All right. As a lending officer, do I or my team have a way to check or know how much of a percentage of the funds are utilized so we can speed up our home search process? So no, and I don't think they're going to. There was a similar program, nowhere near as good, that was out last year. And it had much, much lower income limits. It provided only 10% assistance. And that program started around March, and the money was gone the Wednesday before Thanksgiving. And guess when they notified us the money was gone? The Thursday prior. So basically 7 days prior to Thanksgiving, on the Thursday before Thanksgiving, all loan officers got an email from Cal H of A that said, hey, we're just about out of money on the Equity Builder program. So if you want to use that money, you have to lock your loan by next week on Wednesday. That gave us the rest of the day, Thursday, Friday, Monday, Tuesday, and Wednesday of Thanksgiving week for somebody to get in contract and lock their loan. That was not much notice. So do I expect for them to give us any additional notice? Well, they didn't give us any notice last year, so I highly doubt they're going to give us notice this year. And that's, I wish I had a better answer for you, but I can only go off of recent history of what has been happening. Sylvia asked, how long is a pre-approval valid? The pre-approval is valid for 60 days. But we can extend that pretty easily. So that's actually something I'll be talking about in my masterclass on Thursday night. So I want to not spend too much of this time talking about that piece, because that's more about how to buy a home. And that's why you should come to my How to Buy a Home masterclass, howtobuymasterclass.com. That's the first comment on the top of the comment chart. All right. So Raj asked, what's the maximum home loan limit under this program where the state gives you 20%? I'm going to cover that in a minute. All right, let's keep going. You must have between $1,500 and $3,000 to spend. I already talked about that. That's money for your inspections as well. I didn't cover inspections. So you've got to pay if you want to get a roof inspection, a home inspection, a pest inspection. You're paying your realtor. Your realtor is helping you hire, and you're paying that inspector directly. You're paying me for the appraisal, and then you're paying your earnest money deposit. So $1,500 to $3,000 on average. What are the guidelines? So I consolidated this to make it a little simpler. Maybe it's a little more complicated. Yes, Dylan, everybody. So Dylan said, do the cosigners still have to live in the home for the whole year? Yes, everybody who is on the loan must be a first-time home buyer, must occupy in 60 days, and must stay for a year. All right. So if you're between a 660, Robert, no, you didn't answer that question. I'll cover that in a minute. So if your credit score is between a 660 and a 679, you're allowed to participate only if you're under 80% of the area median income and the maximum debt to income ratio is 45%. If your score is between 680 and 699, you're allowed no matter what your income is, as long as you're under the county cap, but you still have to be under 45% debt to income ratio. And if you're over a 700 credit score, you're allowed any amount of income up to the county cap. It's allowed for anybody regardless of their income level, as long as they don't exceed the county cap. And I can go up to 50% debt to income ratio. All right, Robert. So if the home value depreciates, you still pay back the state the money you borrowed, the original amount, but there's no appreciation. So there's no extra interest you owe them. You don't get a discount off of what you paid them. So you still have to pay them back. Now, if it's dropped enough that there isn't even enough money left to pay back the first mortgage in the state, then the state loses. And it's called a non-recourse debt, meaning they can't come after you later for the money. It does, it is not, you're not going to get any money out of it. Like if the state doesn't get money, you don't get money, but the state does not get any appreciation if the house value hasn't gone up. All right. So Don Slit asked, how do student loans factor in? Does it count against you? Yes, it does. And I'm actually going to talk about that in a second. So monthly growth, how you calculate a debt to income ratio, super, super simple. And this is how I walk through it with you when you and I have our one-on-one consultation. Is I say, okay, Don Slit, how much income do you have? And you say, well, I make $120,000 a year. So great. So that's $10,000 a month. And then based upon where your credit score is, we determine, okay, I can spend half of that towards your debts. So I can spend $5,000 a month towards your debts. From there, I have to subtract your monthly payments. So I'm going to subtract how much do you pay currently for your car payment, how much do you pay for any credit card minimum payments, and how much do you pay for student loans? I'll get back to that calculation in a second. So if you say, oh, I got $1,000 a month between credit cards, car payments, and my student loan payments. Perfect. Then your income's $10,000. I can spend up to 50% of that. So that's $5,000. And you're already spending $1,000. That leaves $4,000 a month that I would let you spend towards a house payment. It's up to you whether you're comfortable spending that or not. So that's where we end up talking about affordability and loan options, but you qualify for a mortgage payment, not for a purchase price. You qualify for, in that case, a $4,000 a month payment. Now it's a matter of, well, how much are you putting for down payment? What are the interest rates? That determines what purchase price you're going to qualify for. Now, student loans are tricky. The reason why is because student loans for right now a lot of them have no payment because they're deferred. And so Fannie Mae says, if you have a payment on your student loan that is defined, I'll use that payment. But if you don't have a payment that's defined, we're going to count 1% of your balance as your minimum payments. So if you have $50,000 in student loans and you're on an income-based repayment plan where you only pay $100 a month, I'm cool with that, but I have to prove that that's the payment plan you're on. If you don't have a payment plan, then I take the 50,000 times 1%, which is $500, and that's what I count as your monthly payment. Even though your payments are deferred, even though you're in forbearance, I still have to count 1%. So it's important to get on a repayment plan as early as you possibly can so that we can make sure we've got that documented. Liliana asked, can alternative credit be used? No, it has to be a traditional mortgage credit score. So we can't use credit. There's something called alternative credit, like using your car payment, or not your car, your payment history on your Netflix account, your payment history on your homeowner's insurance or renter's insurance. We can't use any of that. This requires traditional credit only. Okay, so let's talk about the property. This is Raj's question about maximum home loan limits. So it's conventional loan limits. Now, the conventional loan limits go up to $726,200 nationally. I do expect that we can utilize high balance in the counties that are high balance counties. So for example, I think I do have an example. So here you go. So this is not a purchase price cap. This $726,000 is not the purchase price you're allowed to spend. The $726,000 is the loan amount. So therefore, you can buy a $907,750 home. The state provides you with 20% of that in assistance, which makes your loan amount $726,200, which is the limit for lending in every county across the state. Some counties can go higher. I think I have in here, well, it's 6.5% interest rate. That's $5,700 a month, which means that if you have a family that makes $140,000 a year and has no credit cards, no car payment, or they've paid them off, then you could qualify for this $900,000 home, making $140,000 a year. Now you have to decide, am I willing to spend that? But I would let you spend that. Now you say, John, how many people don't have any credit cards or car payments? Well, how about the down payment money you were going to use to put towards your down payment? Instead of putting it towards down payment, you use the money from this program and you take your money and you use it to pay off your credit cards, use it to pay off your car so that you have significantly lower monthly payments and all you have left is your mortgage payment. That's the way to think outside the box to use this program. You cannot use the state's money to pay off debt, but you can use the money you were going to use for down payment and use it to pay off debt, and then use the money from the state to pay your down payment. So Raj says, to increase my DTI, can I pay off my car loan? If I do it today, how soon will it reflect on my DTI? So that is a great question. And the answer is simple. It reflects on your DTI before you even pay it off. Now, hear me carefully. And I'm going to say this again on Thursday night, because I know all of you are right now going to How to Buy Masterclass and registering for Thursday night. Do not take advice in a environment like this where it's online and I'm providing general information to a large group of people. Okay, so you need to talk to me specifically about what you're trying to do. And when you're looking at paying off debt, there's two reasons you pay off debt. You pay off debt to lower your debt ratio, or you pay off debt to increase your credit score. If you're doing it to increase your credit score, you have to do it early enough for it to catch up and for me to get a new credit report. But if you're only doing it to lower your debt ratio, you can actually pay it off at the moment you bring in your money to buy the house. So you could get in contract today without having paid off your car. And as a matter of fact, I wouldn't want you to pay it off. By the way, guys, it's 7:54 and I'm going to run late. This is good information. I've got more I want to cover, so please stick around. I hope that you're finding this valuable. So here's the deal, Raj, and for everybody, if you're going to pay off debt simply to qualify on debt ratio, I can have you bring in that money at the moment you bring in the remainder of your closing costs, and we have the title company write the check to pay off your car. Now I don't have to prove that it's paid off. If you pay it off ahead of time, I've got to force you to go through the paperwork to prove to me, where did the money come from to pay it off? Is it really paid off? Has the lien been released on the car so that you have the title again? Lots of hoops we have to jump through. But if you just let us pay it off on your behalf, if it's only for debt to income ratio, you can bring that money into you at closing. You just can't use any of the state's money to pay for those debts, but you can use your money to pay for the debts. So the other thing is loan limits. If I'm correct on high balance loans, then what you're looking at is in the Bay Area, in San Mateo County, you can go up to $1,080,000. That's the loan amount. A 20% down payment, you can buy over a $1.3 million home. The state will give you $260,000 for your down payment, and you're going to end up paying less than the $1.08 million in your loan amount. And therefore, you can buy a $1.3 million home in San Francisco or San Mateo County, and you can use this down payment assistance program, assuming I'm correct. Remember, all the rules are subject to change next Monday. Assuming I'm correct, I do expect them to allow high balance. All right, let's keep going. Oh, here's another thing. You pick the property. Thank you, Linda. I appreciate that you're saying it's great info. By the way, Logan, I think I missed your question. When I get to Q&A, if I missed your question as I went along and I never answered it, I'm going to want you to ask it again. Logan said this question may be similar to Julie's. Can we use this loan if we will house hack? So I'm going to have you hold that question, Logan. And when I get to Q&A, if you could ask it to me in a little bit more detail, maybe type it in Word somewhere and word it a little different. I know what you mean by house hacking, but I want more specifics. I'm happy to go as deep as we want to go. Courtney says, would loan count towards multifamily unit parcel property? I'll cover that in just a second. So here's the deal. You get to pick the property. There are so many down payment assistance programs that are tied to a particular property. The Sacramento Housing and Redevelopment Agency, I'm located in the Sacramento area, although I'm talking to a lot of people right now all across the state. The Sacramento Housing and Redevelopment Agency says that they have a program. When they build a home, they'll provide you down payment assistance for that home. The city of Rockland has a program that says, hey, we've got a condominium complex that certain number of these condominiums are considered low to moderate income homes and can only be sold with our down payment assistance program, but you can only use the down payment assistance program to buy that home. This program, you pick the house, any house you want. Now remember, and I'm going to cover this in a second because Courtney was just asking about multifamily properties. I'm not sure if we're going to allow multifamily properties, but within the confines of what we will allow, you get to pick the property. You can pick the location. You can pick the property. It's entirely up to you. Now, here's what we don't know. We don't know the interest rates. So I don't know if the interest rate's going to be at 7, at 9, or at 5.5. I think it's going to be within market rates, which is in the mid 6s right now. And that's what I'm expecting, but we won't know until Monday. We also don't know if it's single family only. I expect that it is going to be single family only. No duplexes, no triplexes, no fourplexes. I expect. So Logan, I think that's your question. Can you buy a multifamily property? I don't expect so. I have a different down payment assistance program. As a matter of fact, if you go to my YouTube channel, John Lone King is my handle on YouTube. I have a live stream that I did a month or two ago. Actually, I have one from a few months ago called House Hacks. I have another one that goes into a lot of this stuff. I spent an hour talking about house hacks. And I have another down payment or another live stream that I did about how to buy multifamily properties. And I explained that there's actually a hack to put only 5% down on a multifamily property, and I can give you down payment assistance for that 5%. So you have to pay the closing costs, but you can buy a multifamily property with 0 down payment. So there's a hack to do that. This program, I don't expect to be that hack. But the other question is, are accessory units okay? I think so. I don't think they're going to let us count rents from the accessory unit, but I do think that accessory units will be okay. Kristen said, what about prefab mini homes? I think they will allow manufactured homes, but prefab mini homes are different than manufactured homes, and I don't expect them to allow those. I'll know more next week, but what we don't know is the exact property types. Here's the other thing we don't know. I do know that homebuyer education will be required, and I understand that there's actually going to be 2 types of education you have to do. You're going to do one that is a normal first-time homebuyer class. So that is going to walk you through what does it mean to be a homeowner and budgeting and a lot of cool stuff. Those classes typically cost money. Most of the time, it's anywhere from $50 to $250. So a lot of down payment assistance programs require those, and this one is no different. But you're also going to have to take a second class about the shared appreciation and how that works. The state wants to make sure that you didn't get a poor explanation from me. I think I did a great explanation, but not all loan officers are created equally, which is why you need to use me, because I explain things very, very well. So the problem is the state doesn't trust that everybody explains things as well as I do. And so you're going to be in a position where you're going to buy a house using down payment assistance, shared appreciation, and you don't understand how it really works and how much money you have to pay back later. And you're going to get very, very angry. The state wants to make sure that doesn't happen. So they are going to require homebuyer education for shared appreciation. What I don't know is what the cost is, who are the providers going to be, how long it's going to take. Nancy says, not familiar with the process, but how are you pre-approving people without knowing the interest rate? What if rates are higher than expected, making a client outside their budget? So first of all, I'm pre-approving my clients at 7%, and I'm not pre-approving people that are super close on their debt to income ratio. So that's really where I'm leaving room, because I have zero expectations rates are going to be above 7%. And if they are, then they either will cancel the contract and not buy because they have a financing contingency, or they'll proceed because they do still qualify. So I'm not going to put somebody in a position to fail, but I have a lot of people who want to get ahead of the curve because there's going to be a rush. All right. So what are the triggering events? When do you have to pay the money back? There's three major times you have to do it. When you sell, when you refinance, or when you pay off your loan. By the way, there's a fourth, and that is if you don't meet your loan agreement, meaning if you are going to foreclosure, if you're way behind on your payments, they can require you to pay back the money. Nobody's going to have that happen, so I'm not going to talk about that part. So when you sell the home, they're going to use the sales price to determine the amount of shared equity. So they're going to take whatever you bought the house for compared to what you're selling it for. The state gets 20% of that number. The seller pays 100% of the real estate fees and closing costs. When you refinance, you are allowed to refinance once. Remember, guys, the rules are published next week. I don't expect this to change, but it could. The rules currently say you're allowed to refinance one time without triggering repayment of the second loan. So if you bought a $500,000 home and you borrowed $400,000 and in 5 years you want to refinance, you can refinance the $400,000 loan that's come down to $370 without including the $100,000 plus appreciation. But the second time you want to refinance, you've got to pay back the state. So theoretically, you're going to be at 6.5% right now. Maybe we'll refinance you when we get to 5%, and then it's going to save you a few $100s a month. And then when you get to 3.5%, you refinance and you pay back the state. And that way your payment might not drop because you're bumping your balance, but now you no longer have a partner growing in your appreciation and you didn't bump up your monthly payment. All right, Alonzo had a question. Remind me, if I buy a home and I decide to stay in it forever. So I'm going to cover that in just a moment. So what happens though, forgetting about what Alonzo said for a moment, is when you do a refinance, they're going to, when you pay them off through refinancing, either through cash out in the future, you've got to pay back the principal plus the shared appreciation. CalHAF is going to order an appraisal or an online valuation. It's their choice. You cannot argue the value. You cannot say to them, hey, I disagree. I think the house is not worth as much as you think it's worth. It doesn't matter. Their number is their number. They're in charge of the money. Now, I don't think they're going to be unrealistic. They're going to go to a third party that gets an appraisal done or a third party online valuation, but there's no arguing that number. Now, to what Alonzo said, when the loan is paid off, if you stay in your home forever and you pay off your mortgage in 30 years, then you have to pay back the state at that time. Now, how are you going to come up with the money to pay back the state? We're going to refinance you. So you're going to owe some money at that point in time. Most people don't keep their home for 30 years. Most people, if they do, refinance along the way, and we pay off the state long before that. But what happens is you pay back the state. There's a cap of 2.5% of your original, 2.5 times, excuse me, your original balance. So if you got $100,000 originally, the most you pay back in interest is $250,000 in additional interest. You also pay back the shared appreciation when you pay back the full balance of the assistance loan. So if you got $100,000 from the state and you say, hey, I'm going to pay back the state's, that $100,000 right now because I have $100,000, they won't accept your money. They'll take most of it. They'll take $99,000 of it. But as soon as you get to the point of having a little bit of money left and you want to pay back the remainder, they're going to refuse your payment and they're going to run the calculation to say, wait, we want to get your payment for the remainder plus what you owe us in appreciation at this time. All right. So shared appreciation. I think I've gone through the numbers enough. This one's really, it's covering what we talked about already. I'm going to skip through this really quick. What I want to talk about is really, what is this program really costing you? Like when people look at the bottom line, and this is really, really important for you to understand the math. Somebody's going to look at the bottom line and they're going to say, you know what, John, it's not worth sharing 20% with the state. Let me give you the math. If you bought a home with 3% down and no sharing, your payment's $4,200. If you sell in 5 years, so let me get my spotlight here. You sell in 5 years, you've made 60 payments of $4,200 or $252,000 in payments. Your sales price when you sell is $700,000 and your balance is 442. Okay, because you put 3% down. And if you look way down here at the bottom, you'll see that this is based on a $500,000 purchase price with a $485,000 starting balance on the left side. So you take your 700,000 minus the 442, your gross proceeds before paying the state is $257,000. Now, what if you go with this scenario? So you did the 20% appreciation loan, which means that you're only paying $3,300 a month for the next 5 years instead of $4,200. So your payments are only $199,000 in the next 5 years. You saved $53,000 in monthly payments. Most people forget about that part. So now you sell the house for $700,000. Your balance was lower. You owed less money at starting at $400,000. So your balance is only $376,000. Now you have to take into account you're paying back $140,000 to the state. The $100,000 that you got as the loan plus the appreciation. The house went from $500,000 to $700,000. So you pay them $40,000. But guess what? You saved $52,500 of extra money sitting in the bank because you didn't write a check for that $52,000 in payments. So you should have extra money in the bank compared to what you would have had you made this monthly payment, which means your gross proceeds is about $236,000. So it costs you $20,000 to take this loan, not $40,000. The state got $40,000 because of the appreciation, but you didn't have to make monthly payments on the state's portion. So you saved $52,000 in monthly payments that you didn't have to pay. It puts you in a better position. I'm not saying it's better than if you sold the house with you getting 100% of the appreciation, but you didn't lose $40,000. In my calculation, you lost 21, and it wasn't a loss because you gained the other amount of money. You walked away with $236,000 that you would have had none of that if you rented for that 5-year time frame. So you can buy this $500,000 home and pay $4,200 a month and get $257,000 in 5 years. So assuming these assumptions here, or you can buy the $500,000 home and only pay $3,300 a month, and you walk away with $236,000. Or you can stay being a renter and you get nothing in 5 years. I don't know about you, but the choice seems really, really simple. All right, I'm about to get into Q&A. I appreciate you guys' understanding. I want to cover a couple of things on next steps. Okay, so first of all, how to make your dream a reality. So this QR code takes you to my loan application. If you are ready to start, if you said, John, I want to get pre-approved and I know you're going to be busy on Monday. I'm going to be busy on Monday. I want to get started now. You can either go to this website, apply.johnloanking.com, or simply scan this QR code. And when you scan the QR code, it'll be taking you to my website and you'll be able to start your journey there. I'm going to bring back this QR code in a minute, but I want to show you one more thing, and I need your help. I need your help sharing this information with your friends and family. And it's simple. I want you to send them to my YouTube channel. I have a special YouTube channel dedicated to this program only. So if you go to YouTube and search for California Dream for All, you're going to find a whole bunch of videos, but there's only one channel named California Dream for All. And you can find that channel by scanning this QR code. So scan this QR code. It will take you directly to YouTube and it'll take you to a playlist. I've got 25 1 to 2 minute videos going through a lot of the things I talked about tonight. So if you have somebody who's thinking about this program, send them this QR. Take a picture of this right now or watch the replay. This replay is on my Facebook page, or you can contact me and I'll get you a copy of the recording so that you can replay it. But the bottom line is I need your help, and I need you to help make your friends and family's dream of California Dream for All a reality for them by sending them to my YouTube channel. So please, everybody, take out your phone right now. Please take a picture, use your camera, scan this QR code, and then subscribe to my YouTube channel. And then you can share this link with everybody that you know. All right, so let's go ahead. By the way, you can find that YouTube channel here also by going to californiadreamforall.info is another way you can find the YouTube channel. All right, so let's dive back into questions. Subhan says, not sure if we know at the moment on loan processing fee or origination. So I don't know. I do know that down payment assistance loans By the way, it's Suba. I apologize. I think I said Suban. So Suba, I don't know. I expect it to be like most of the other down payment assistance loans, which means you pay 2 points or 2% of your loan amount in an origination fee plus underwriting and processing. CalHAFA normally has between a $500 and a $700 bond review fee. And then there's also, if you're in a high balance, if your loan amount's over $726,000, then there's a pretty hefty high balance fee that's charged as well. So the fees, I don't know any specifics on it, but I expect it to be the same as all the rest of the down payment assistance loans. Jessica asks, does this loan work for buying more than one single family home? Well, here's the challenge. You can only use it when you're a first-time home buyer, and you must occupy the home that you buy. So as soon as you use it once, you can't use it again. Once you sell that home and you don't live there for 3 years, then you can use it again. But once you use this, you can't buy a second one, and you can't use it with your spouse. Like that whole two-step I talked about, where I'll do one and my spouse will do one. No, because we know you're gaming the system, so they've closed that loophole. Alonzo, looking forward to the call and email. You are ready to go. All right, my friend, I appreciate that. Suba, thanks, John. Appreciate your time and patience. This is awesome. Sylvia, when it comes to refinancing to pay back the government, how does that affect your original loan? That is a great question. By the way, anybody else that has questions, please feel free to post them into chats. Remember, you can go to californiadreamforall.info for all the latest updates, and that will also take you to the YouTube channel. There's a YouTube video playing right in the middle. You can click on that, and it'll take you to the YouTube channel for this. Scan right up here for the QR code for starting the application. So if you're ready to go, and you know, John, I'm ready to go. I want you to pull my credit. I want to look at my income. When you put, by the way, Sylvia, I'm going to get to your question in a second. When you go to that website, it's going to ask you everything about your income, your social security number, your employment history, and then it's going to give you a list of paperwork we need that is based upon how you answer the questions. So you'll be able to upload into our secure portal everything that we need from you. And while I'm answering Sylvia's question, I'm going to go back here to the QR code that you guys need to scan to send this to your family. You can also find it at californiadreamforall.info. So Sylvia, when it comes to refinancing to pay back the government, how does that affect your original loan? Well, remember, there's two situations in which you'd be refinancing. You'd be refinancing either the first time, simply refinancing to lower your monthly payment. That's called a rate and term refinance. If you're doing a rate and term refinance, the first time you do it, you don't have to pay back the second mortgage. Now, you do have fees when you refinance. You're paying upwards of $10,000 in fees on average when you're refinancing, which is why I want to make sure that you save enough money for it to be worth it, but don't do it too soon, because you only have one time to do the refinance before you have to pay off the second. So I want to finish explaining this in a little bit more detail. The first time that you refinance, if you're not pulling cash out, then you simply, the loan amount is whatever you owe at that time plus fees is all your new loan amount is for the new first mortgage. And then the assistance loan stays where it is. The second time you refinance, or maybe the first time you want to refinance and you want to pay back the state. You're like, hey, John, values have gone up enough. I'm done with my partner. I'm going to wash my hands of the state. I want to pay them off and I have enough equity that I can. We might make that decision that says the first time you refinance, we're paying off the state. Now, that means you're increasing your loan amount. That means that your loan went from $370,000. Well, you got to pay back the state there, $100,000 plus the appreciation of $20,000. So your loan amount is going up to $490,000, and then you have fees. So now you're going to owe $500,000 when you refinance. So your payment would then at that moment be based on the $500,000. So your lower interest rate should offset the increase in principal, but you might end up not saving anything per month. Maybe that's a good thing. Maybe, hey, John, I'm happy with my monthly payment and I want to wash my hands of my partner. So if I can refinance at a point to buy them out and keep the same monthly payment, I'm going to do it. Let's make it happen. And so this is a question that I'm going to work with you to help decide when you should refinance and whether you should refinance to pay off the state or not. I've been doing this for, 23 years. I started in 2000. I plan on doing it for quite a few more years. So you guys are stuck with me. I've prided myself in taking great care of my clients so that every time they refinance, they come back to me, they send their friends and family to me. And so I'm going to be here to guide you through this process and help you decide, is now a good time to refinance or not? That is one of the biggest challenges that, even though this is an amazing program, it's going to be one that we're going to be dealing with going forward. And I will be proactively reaching out and staying in regular communication with you. I do regular YouTube updates about what's going on in the market and where I think interest rates are going, where I think house prices are going, and I'm going to help guide you through that process. The other thing you get with me is a monthly home digest. So once you buy your home, you're going to get an email from me every single month that says, hey, this is how much you've built up in equity based on how much the balance has paid down versus how much your equity has increased. It gives you some ideas on how you can use some of the equity in your home, and maybe you can save money per month by refinancing. So you'll get a monthly home digest that kind of serves as your bank statement for your mortgage. It's really cool. My customers love it, and you're going to love it, and you're automatically enrolled in that once we close your loan. Tiffany asked a question. By the way, guys, I'm talking because if you have more questions, feel free to post them in here. Tiffany, if your loan app, when you ask about a down payment, do we put 0 if we plan on using the California Dream for All program? Yeah, go ahead. Actually put 20% down. When we talk, we'll know that you're using the California Dream for All program. If you really want to be thorough, under assets, you can list a bank account called California Dream for All, and that'll tell me that's what you're applying for. But we're going to follow up with you immediately. So if the computer stops you and says, hey, you can't proceed without putting a down payment, just put 20% down. I'm pretty sure it'll let you proceed with 0 down, and that's okay too, because I've got to make changes on my side once I receive the application. But go ahead and fill in that information, and as long as it doesn't stop you, I'll be following up with you on my side. All right, perfect. Looks like Tiffany's already starting. So it's a race to see who can get the first application in tonight. You don't win anything. It's pride, not prize. Sylvia says, does the state have the right to request their payback anytime? No. So there's a loan agreement and there's a note. The state cannot just call you up and say, hey, I kind of need some of that money back. You know, remember that money I loaned you last week when you were taking my sister out on a date and you didn't have enough money to pay for dinner and you borrowed that money from me? I kind of need it back. The state's not going to do that to you. The state is going to, they have rules on when you pay back, and there's triggers on when you have to pay back. So no, they're not going to call you and say, hey, I need to get my money back. Suba says, in the pre-approval letter, is it going to mention anything about Cal HFA? I put that in my pre-approval letters. So I'm putting buyer utilizing California Dream for All assistance program so the agent understands. Tristan says, can you please go over that thing about lower income or lower monthly payments? Lower income, but with 750 credits, super low debts to income ratio. So lower in the challenge, Tristan, is what's your debt to income ratio going to be? The lower your income, then the more higher your debt to income rate, the higher your debt to income ratio is going to be. As long as you qualify, if your income is less than 80% of the area median income for the county you're buying in, then you get one single benefit, which is that when you sell the home or when you pay back the assistance, you only pay back 75 cents of every dollar that other people are paying back. All right, Linda's got to head out. She'll be reaching out further to discuss it, and her son. So if you have children, make sure you get your children in touch with me as well. Gang, I know I'm way over time on this. If you have any other questions, feel free to post them into chats. You can also email me. My email is on this page as well. So if you have questions and it didn't get answered, shoot me an email. And if you're ready to start the process, scan the QR code and start now. So thank you everybody for joining me tonight. Please send your friends and family. I'll be doing this again next week on Monday night. And don't forget the How to Buy Masterclass.com. So go to How to Buy, I'm typing it in, Masterclass.com and register for the masterclass this Thursday night at 7 o'clock. Looking forward to seeing you all there. Looking forward to helping you guys make your California dream a reality for you. Thanks again and have a good night. Bye-bye.